Welcome back to NYSE Live. Global leaders like President Donald Trump to industry titans like Elon Musk and Jamie Dimon convened in Davos, Switzerland last week at the World Economic Forum. NYSE President Lynn Martin was on site too. Well, joining me now to talk more about what unfolded and what comes next is Daniel Lacalle. He's chief economist at Tressis. Daniel, good to see you this morning, joining us from London. What were your takeaways from Davos this year?
I think that the main summary of what happened in Davos was the clear evidence that for years we heard that the solutions to global complex problems were big government, high taxes, government interventionism, and also uncontrolled immigration. And in this particular event, what we have seen is that the overwhelming response from the audiences and from businesses is that those are not the answers. And the United States has shown with, I think it's the biggest group of officials that came to Davos in a very long time, that there are better ways of leading economic growth and that those only lead to stagnation. And we saw from Canada, the UK, France, Germany, the United States is growing at a 4%, 4.4% annualized rate, while the rest of the peers globally, Germany, France, Japan, the UK, Canada, are all in stagnation. No? So I think that the big, let's say, summary, the big conclusion of Davos is that the old Davos is dead and that a new Davos that is focused on free markets, on open economies, on entrepreneurship and business development is coming back to life.
Does this change your economic projections for 2026, Daniel?
I think it does, because if you think about it, one of the big challenges for 2026 was that all of those negative elements that had been building for years could lead to a massive reduction in economic growth. At least for 2026, what we see right now in our latest projections is that the United States is going to be the global leader of developed economies in terms of economic growth. It's going to be above 2.6%. It could reach 3% easily. And at the same time, the euro area is going to avoid a deep recession precisely because Germany gave a very, very strong message in Davos in which Chancellor Merkel said that the enormous level of over-regulation, the big problems of the European Union needed to be solved. Those are positives. And I think that little by little, we are seeing developed economies do a little bit better, abandoning that statism and interventionism. And at the same time, emerging economies like India are doing very, very well, also opening to the world and reaching new agreements. And that is also a positive.
I do want to talk to you about the Fed, Daniel, because not only are we getting a Fed decision on Wednesday, and markets nearly certain, earlier this morning it was a 97% chance, the odds that the Fed does hold rates steady at its first meeting in 2026, but we could hear as soon as this week President Trump's pick for the new Fed chair, set to, of course, take the helm in the latter half of 2026 as Jerome Powell's term expires. What matters here?
I think that what matters is that the Fed finally admits that they were incredibly wrong about inflation, because the decisions about rates that they have taken were based on an idea that tariffs would generate an enormous level of inflation and a very big problem for the United States economy. None of those things have happened. So once we have a very clear picture of those disinflationary pressures being quite evident throughout the US economy, then it is important that the Federal Reserve changes its course and brings rates back to the neutral level. They may hold rates in this meeting, but the Fed needs to at least cut twice this year, because we have to remember that holding rates so above the neutral level is very damaging for the labor market. Holding rates for 100 basis points above the neutral level for a year, according to the Federal Reserve of Minneapolis, reduces job creation by 1 million because it hurts small and medium enterprises that are the biggest drivers of job creation. Therefore, what we need to see is that the Fed goes back to the neutral level. That would require at least 2 rate cuts, and it's important that the Federal Reserve abandons the narrative of tariff impacts and goes back to what they should be, which is data dependent. And I think that the nomination of a new chair president is very, very relevant, because that is what is expected from markets, that they are truly data dependent and not shifting from data dependent to narrative dependent according to estimates that then become wrong and hurt the economy.
Daniel Lacalle, chief economist at Tressis, with a Davos recap. Daniel, thanks so much.
Thank you very much. Have a great day.